If the market itself shows negative rent growth for more than 2 quarters, don't buy something.
Welcome back, investors. Today, I have the pleasure of interviewing one of the top operators in multifamily real estate, Neal Bawa. He's known as the mad scientist of multifamily. And if you're not familiar with him yet, you'll see why in a moment. He's made a career out of applying data science to investing and helping others along the way. Today, we'll discuss data science, macroeconomics, housing data, and the best markets to invest in. Welcome to the show, Neal.
Well, thanks for having me on the show. It's great to be here.
All right. Well, it's a great pleasure to have you on, and I always like to let my guests introduce themselves as well. So, suppose you're at a cocktail party and somebody asks you, "What do you do?" How do you answer that question?
Well, I'm a computer science graduate, a technologist that's recovering from technology and using technology to make money and do great things in real estate.
Well, I love it because as a PhD, I had to sort of repurpose my career. I sometimes refer to myself as a recovering PhD. So I guess there's life out there in your second or third career these days.
Yeah.
Most people will find themselves doing many things, many walks of life in their careers. First thing I'd really like to talk about is supply and demand. We've had a huge imbalance. We have a tremendous housing crisis as of today, recording in early 2026. I'd like to see what do you think are some of the factors influencing that supply demand balance, and how do you see things progressing 2026 and beyond?
So I'd like to address that question by breaking it up into two pieces, single family and multifamily. We often see numbers from credible sources like Fannie Mae and Freddie Mac. These are quasi-government organizations that do hundreds of billions of dollars in loans. And I will see numbers that go all the way from we're 2 million homes short to 5.5 million short, depending upon which vendor you're listening to today. And in general, I'd say it's probably likely that we're 2 million homes short. It's highly unlikely that we're 5.5 million short because the 5.5 million number assumes the kind of population growth that we haven't seen in the last 5 or 6 years and assumes the kind of immigration that we are not going to see for the next 3 or 4 years at least. So correcting for that, we're still 2, maybe 3 million homes short in the United States. I want to point out that most countries in the world have this kind of a shortage, so we're not unique in that. And the shortage has been long lasting for a variety of reasons, but I think the single biggest reason is it's extremely difficult at today's construction cost to build a home that is for the common person. So I'll define a common person as, well, you're living in a tier 2 metro. Maybe you're not living in, a coastal metro. You're living in a tier 2 metro. Could be Chattanooga or Salt Lake City, right? And you're living there and you're making $80,000 a year. Well, then you can probably afford a mortgage of about $24,000 a year, which is roughly 30%. Maybe we can go up to 35%. Well, that's $28,000 a year. Well, in those tier 2, tier 3 metros, no one can sell you a home today that will have a mortgage that low, right? So your mortgage is probably going to be closer to $40,000, which you can't really afford. The bank wouldn't give you a mortgage that's 40% of your 40 or 50% of your income. And so the challenge is that it's not that we can't build homes. There's actually no shortage of homes. It's that we can't build homes that match the median salary of the normal American, middle class American. And that's what's keeping this, keep creating the shortage. I'm sure we can build all of the homes that are needed for every American. If every American, just got a salary as a raise of $50,000 today, the shortage would be done in 3 years, right? So it's not a shortage of homes. It is a shortage of money needed to buy the homes. So it's very important to understand that. Now, on the multifamily side, people start assuming that that 2 million home shortage is also a shortage for multifamily or apartments. That's not true. I think the shortage there is about 600,000 units. And that shortage also goes up and down. And the reason for that is something known as household creation. A lot of people are like, well, there must be a certain number of households in the US. Not really. That depends on the economy. When the economy goes down to 3% unemployment, there's more households. When it goes to 6% unemployment, there's less households. And how do you reduce the number of households? People obviously don't vanish into thin air. And the answer is people go back to sharing. People go back to living in their mom's basement or living in their car. So the unemployment rate of the economy actually controls the total number of households. So on the multifamily side, it's much more flexible. Obviously, you can't do that if you've already bought a home. You sort of muddle through it. Even if you're unemployed, you borrow money against home equity or whatever, and you try to keep your home. But if you're a renter, then people find all sorts of different ways to rent, like renting jointly, sharing a room, going back and living with mom and dad. Those sorts of things happen. So that piece is flexible. And while there's a shortage there for the moment in early 2026, there's actually very little shortage of multifamily properties. It's going to build up again over the next 3 years because we're doing very little new construction.
Right. So I'm glad that you broke that out. Essentially, it sounds like what we're talking about here in some ways is a shortage of financing with rates
Yeah.
so high. That's certainly going to change what constitutes a affordable home. And then also, yes, of course, most of our listeners here are multifamily. And I think it's very good to point out that the size of the shortage there is different and it is very variable because, yeah, we have seen a lot of multifamily supply come online. And as you pointed out in your interviews, it takes a long time, like a couple of years, 21 to 24 months, for these starts to turn into completions in the multifamily space. And so that wave, I think it just really hit us a lot more recently.
Yep. Yep. And while we are not delivering a lot of new units in multifamily in 2026, a lot of the deliveries were in 25. Just remember that if you have a 250 unit property that delivered, let's say, even on January 1st of 2025, so 15 months ago, it's probably still not full, right? Because if they're leasing 15 units a month, then in 15 months, they've barely gotten close to the point where they can consider themselves to be full. And most properties are not leasing 15 units because we're competing with so many other properties that if you're leasing 10 units a month, well, it's going to take you 24 months to lease up, right? So it's extremely important to understand that we don't have a lot of new supply in 2026, but we have a massive number of properties from 2024 and 2025 that are not yet leased up. And that's what's keeping rent growth negative in growth markets. Most Sunbelt markets have negative rent growth currently. And if they don't have negative rent growth, they have 0% rent growth. And just so you know, if inflation's 3%, and with the war, it might go up, then 0% rent growth is really minus 3% rent growth. Because if you look at a 50-year chart chart that shows rent growth and inflation, rent growth usually tends to be 1% higher than inflation. Why? Because firstly, rents are the single biggest factor in inflation, right? If you think about it, where you live and the food that you eat, the gas that you use, are really the three biggest components of inflation itself. And because it's been very, very hard to make cheap single-family homes, cheap multifamily homes for a long time now, 30 plus years, rents tend to be above inflation. So if inflation is at 3%, rents tend to be at 4. That's common. That's normal, right? Well, right now, if they're at 0, let's say in a market, we can't be too happy about it because it's not negative. Well, it's kind of negative because normally they're 4, and right now they're 0. So that's minus 4 when you compare to a normal time frame. And so we're seeing that across the board in Sunbelt markets in the US. And here's the cool part of it. And I'm going to get really geeky and technical for a second. As of Q1 2026, we are now seeing more and more markets in the US, even in the Sunbelt, even the growth markets with a lot of supply, where the absorption of units is higher than the supply of units. So what they're saying is, well, this particular submarket in Chattanooga is going to deliver 1,000 units in 2006, and we're going to absorb 1,200 units. Now, that's good news. It is good news.
Yeah.
It sounds like good news. But here's the problem. When you absorb the 1,200 units and only 1,000 are built, well, you have to make an incorrect assumption that there are no previous units that haven't been absorbed yet. Well, we do have thousands of units that came online in 24 and 23 that are yet to be absorbed. So for this year, if we were in a vacuum and didn't have any of that old supply, so many markets now are positive absorption. Yay.
Right.
But so many of those markets are still dealing with the unabsorbed inventory from 24 and 23. And that's what's keeping the markets in negative rent growth. Now that is going to end this year for most markets in the US. I don't think it'll end for Phoenix. I don't think it'll end for Austin, San Antonio, and a few other markets in the US. I don't want to name all of the ones that are problematic, but a ton of the growth markets by the end of 2026, all of that supply from 26, from 25, from 24 would have been quote unquote absorbed. And once you hit 95% occupancy and you're not seeing eight weeks of concessions or 6 weeks of concessions, we start to see rent growth very quickly. A lot of people are like, how can that happen so quickly? The answer is very
Right.
simple. 1/3 of all properties are using what is known as rent management software, basically to set their rents, just like airlines, change their prices every day. These properties are changing their prices. So these properties are snooping on every other property using software like Hello Data. And so when they start seeing the concessions go down, they start pushing their prices up $5 and sees if it holds. Okay, great. Now they see concessions go down further. They push up the price another $5, another $5. So because this is an industry that is using rent management software, right? We tend to see turnarounds be pretty quick. A market can go from being oversaturated to having aggressive rent growth in just 6 months.
Yeah, pretty amazing the degree to which certain markets have experienced elevated vacancy. Chattanooga is a great example of that. Now, obviously, there are ways we can predict the supply coming online. CoStar, for example, what is the best way that you would predict the markets that are going to have negative absorption, the markets that you'd stay away from?
So my short answer is that CoStar itself was very bullish about this absorption a year and a half or 2 years ago. So if you use their data, it probably didn't do you much good.
Yeah.
But I've seen CoStar become a lot more conservative over the last 18 months. So here's what I'd say today. Um, let's say you're looking at Chattanooga, perfect example, right? So, it's a tier 3 metro, 500,000 people, and you're like, okay, I'm interested in Chattanooga for some reason. Well, pull the CoStar report today for the market and then pull it for the sub-market. And I'll give you feedback on where I think you should be. If the market itself shows negative rent growth for more than 2 quarters, don't buy something. You can build something because when you build something, you're not going to deliver for another 2 years, so it doesn't matter. But if the market report in that page that you see the orange
Right.
bars, right? Right now you're going to see a bunch of negative orange bars in the last 2 years in Chattanooga. If you're
Right.
seeing two more bars into the future that are showing negative rent growth, then it's too early to enter Chattanooga. Now, on a sub-market basis, you want to be even more careful. The sub-market that you're entering should not have any negative bars in the future. Not at all. Because the market, obviously, the supply, if there is more supply, it'll get averaged out. But in your own sub-market, you do not want to go into a sub-market that predicts future negative rent growth, because now your pro forma is really getting damaged because you're assuming positive rent growth and the market's showing negative rent growth, and that's happened a lot. So in my mind, those are the two numbers that you may want to look at. 2 quarters maximum for the metro and 0 quarters going forward for the sub-market that you're investing in. And that puts you as close theoretically to the bottom of the market as possible. Why? Because there's been negative rent growth, and whoever is selling this property to you, they've had to take that hit because you're buying the property based on T3 and T12. So last 3 months, if they've had negative rent growth, you're going to pay less for this property. That's obvious, right? You're paying it based on that NOI. And if that negative rent growth is ending, that this is as close to the lowest price you will get for this property as possible.
So speaking of pricing, would you say that we've hit bottom here in Q1 of 2026, or will we reach bottom sometime later this year?
That depends. That depends, and I'll define it from two perspectives. From the perspective of cap rates, yes, we absolutely have hit the top of the cap rate. So
Mhm.
when we talk about bottom of cap rates, it's really theoretically the top of cap rates, because higher cap rates is lower
Mhm.
prices, right? It's inverse.
Mhm.
So have we hit
Sure.
peak cap rate in this cycle? Yes, and actually we hit peak cap rates in this cycle more than 9 months ago. The peak cap rate
Yeah.
was early in 2025. And then after that, the cap rate declined because there were four interest rate cuts in 2025. And every time there
Hmm.
were interest rate cuts, we saw like a 5 basis point drop, right? But it wasn't a
Hmm.
huge drop because the sentiment didn't change, right? There's no aggression in what investors are doing. So the cap rate has dropped, but it's dropped by a very small amount. For 100 basis points, if the sentiment was strong, it should have dropped a lot more. So we have seen unquestionably a drop in cap rates, but it's been very small, so it hasn't been very helpful. Now, from a price per unit perspective, we may not have seen the bottom because negative rent growth drags down price per unit, even if cap rates are dropping, right? Because
Hmm.
so on a per unit basis, I'd say we are close to the lowest price per unit that we are going to see in this cycle,
Right.
but certain markets might still go a little bit lower in 2026.
Fair enough. Well, hopefully seasonality will be to our advantage as the weather is improving these days. Now, what about timelines for these price increases? So we're gonna, hit bottom in terms of prices soon, we hope. I think you've predicted recently that we're going to have significant supply imbalance for at least about another 4 years or so until 2030. So, what is the longer term outlook for multifamily prices look?
I think 27, 28, and 29 would be the 3 years that we're going to benefit from not having a huge amount of inventory. Because
Hmm.
as we're looking at permits being pulled today on a nationwide basis, it varies city by city, but on a nationwide basis, we're certainly seeing a drop. Some markets have dropped 30, 40% from peak. Some have dropped 60%, like San Antonio, for example, was some absurd number, almost 90% from peak. Um, so as we are seeing those drops, it's not enough to backfill. It typically takes 30 months to build a building, right? From the time you pull permits to complete it these days, it's taking, certainly 2 years. Many projects take 30 months. So we think 27, 28, and 29 are good rent growth years as long as demand holds up, right? So everything that I'm about to say, the big caveat is, can demand hold up? The answer is it probably will, but there's AI, right? So we don't know what the impact of AI is to the job market. So I'll leave that out there as an X factor.
Hmm.
Just like COVID was an X factor, in 2020. AI is an X factor in 27, 28, and 29. We have not seen much job losses from AI as we sit here in the beginning of 2026. I don't anticipate that there will be significant job losses in 2026, but I'm not so sure about 2027. So maybe I'm wrong, and there aren't a lot of AI job losses. We should see strong rent growth in 27, 28, and 29, which should help us turn around the pricing of the properties. I'm not so sure about cap rates because the way I'm seeing it, I only see one rate cut this year, and it's going to be towards the second half of the year. I'm very hopeful that the war in Iran is very short. If it goes on longer, we're not going to get that rate cut.
Yeah, fair. So we talked a little bit about markets, and I think we will talk about AI briefly shortly. But I want to talk about something that perhaps newer operators don't focus enough on, which is operations. And one of the biggest impacts on operations, of course, is your property managers. Now, nobody can invest seriously in multifamily without having some property managers. How do you deal with issues with property managers? Do you tend to fire fast, take them to court? What do you do when you have a difficult situation?
We haven't taken any to court. I think the best way to deal with it is to fire them and move on, unless they keep your money, which has happened once, and we,
Hmm.
sort of went through the threatening process and eventually they paid up. So it's really been problematic. I mean, we just fired a property manager with a 1 year contract. We fired them after 10 months for non-performance. It's been
Right.
very problematic, and I think that frankly, what has happened in the US is this, and I'll say this, and this might get me in trouble with the people listening to you. I think a lot of property managers that are charging a 3% interest rate or 3% rate, 3% of rents, they themselves made the assumption that multifamily will not see the kind of vacancy issues that we are seeing now. So the
Hmm.
truth is, for the kind of work that property managers are doing today, with all the challenges that we're having, they're underpaid. And because they're underpaid, they're trying to cut corners themselves. They're not making money. They're getting fired left and right. And every time a property manager gets fired, it costs them an incredible amount of money to go find a new client. And so what we are seeing is perennial underperformance. 7 out of 10 properties are underperforming, not just for market reasons. Obviously, they're underperforming because there's supply, but they're also underperforming because their property managers are doing very poorly. A lot of property managers, their 3% fee was based on them sitting on properties where the rents are always going up and the occupancy staying above 95%. And that's just not the case today. And most property managers are not prepared.
Right now, last hour, just one final question. Email, website, carrier pigeon, or smoke signals. What is the best way for our listeners to reach out to Neal Bawa?
We believe that knowledge should be free. So we've created sort of a Wikipedia for real estate, data, and it's at multifamilyu.com. Don't forget the U, multifamilyu.com/club. The club is free. We do not provide paid education. We have no upsell. 1% of the people in the club eventually end up becoming investors with us. The remaining 99, they get years and years of free education, including 6 powerful webinars every year that we provide to our database.
Okay, well, beautiful resource. Thank you very much. I want to thank you for taking the time to share your knowledge and experience with our audience.
Thanks so much. Have a good one.
All right. Thank you. Take care.
Mhm.